Welcome back to Investing Talk Podcast.
Today we're looking at RCAT Holdings.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. With RCAT Holdings, if you really want to understand why institutions are suddenly paying so much attention, you have to start with the revenue.
Right.
Because it's really the foundation of the whole bull case.
When I first saw those numbers, foundation felt like an understatement. The growth is just, it's staggering for a company of this scale.
It really is. We're talking about their Q3 2025 revenue coming in at $9.65 million.
Okay, which on its own might not sound like a huge number compared to a mega cap or something.
Exactly, but it's the rate of change that matters here. They posted a 646% year-over-year increase.
Wow.
Which is huge, but here's the signal that really got the smart money interested. A 200% sequential increase from the prior quarter.
Okay, let's pause on that sequential number. Why is that 200% jump from Q2 more important than the huge annual number?
Because year over year can sometimes be, well, a bit misleading if the base from last year was tiny or maybe there was a one-off event.
Right.
But when you see sequential growth quarter on quarter accelerate by 200%, it tells you demand is picking up right now.
And that they can actually handle it.
That's the second part. Their operations are scaling up to meet that demand almost instantly. It's the textbook sign of a real revenue inflection point.
And management seems to think this is just the beginning. They're not being shy with their Q4 guidance at all.
Not at all. They're targeting between $20 and $22 million. If they pull that off, they're nearly doubling Q3. It would just confirm this massive shift in demand.
So if they hit that, what does that put them at for the full year?
You'd be looking at a range between, say, 34.5 and 37.5 million for the full year 2025. This isn't just growth, it's rapid market penetration.
But can they afford it? I mean, that kind of growth has to be burning a ton of cash. What's the balance sheet look like?
That's the key question. They closed Q3 with $212.5 million in cash and receivables.
Okay, so that's a massive war chest.
It's a huge runway. It means they have the security to fund operations and, more importantly, invest aggressively in these new programs without running back to the market for cash.
And that cash position is really the key that unlocks this next chapter, right?
Right.
The massive capital raise they just did.
Absolutely. The defining move here was that $172.5 million public offering they closed in September.
That's a huge raise.
It was a massive declaration of confidence from management. I mean, you don't take on that kind of dilution unless you see a much, much bigger opportunity right around the corner.
But dilution is always a concern for shareholders. How do we know this was a smart move? What convinced the big institutions to jump in?
That's the right question. And the answer is in the details. First, the money is specifically earmarked for their new unmanned surface vessel division, USVs. So it's very targeted.
It's not just for general expenses, it's for a specific strategic pivot.
Exactly. Moving beyond just software into actual physical platforms. And the institutional response was, well, overwhelmingly positive.
How can we tell that?
Two signals. First, the underwriter fully exercised their over-allotment option.
Which, for listeners, means demand was incredibly high, right?
It's a textbook signal. It means the offering was oversubscribed. They could have sold way more shares at that price. It just screams conviction from the market.
So that's the external signal. But I thought the internal one with Lind Global was even more telling.
Oh, it absolutely is. So Lind is a sophisticated convertible debt holder. And they voluntarily waived their anti-dilution rights during this equity raise.
That's highly unusual. They basically gave up their protection against this new stock being issued.
They did. And why would you do that? The only reason is if you believe this cash injection for the USV division is so value accretive that it's going to make the whole company so much more valuable that your slightly smaller piece of a much bigger pie is worth way more in the end.
It's a huge vote of confidence from a real insider.
A massive one.
So the smart money is in, and it's funding this big move into a new market, a greenfield market. What's the strategic advantage here with USVs?
It fundamentally changes their business model. They're moving from, software and licensing fees to selling the entire platform. The unit economics are just so much higher.
And this all ties into their government and defense focus, I assume. with certifications and all that.
Crucially, they have the Blue UAS certification. This is so important. It's from the Department of Defense, and it basically says their tech is secure, trusted, and free from, adversarial components.
With a massive competitive moat.
It is. It just shuts the door on so many competitors that don't have it, especially when you're bidding for high-margin government contracts here or with NATO allies.
Okay, so the bull case is incredibly strong. You have revenue exploding, a huge pile of cash, big institutional buy-in, and this strategic pivot into a protected market. It feels like a slam dunk.
Wow.
So let's talk about the bear case. Where does the risk come in?
The bear case is one word: execution. That $172 million is a bet on a USV market that is, for them, still commercially unproven.
They have to build it from the ground up.
Exactly. So if that division doesn't hit its targets in the next, say, 12 to 24 months, then all that dilution suddenly looks value destructive. That is the number one risk.
And there are other financial risks too, right? Beyond just the dilution.
For sure. Even with that explosive revenue, profitability is a concern. Their gross margin in Q3 was just 7%.
Oof, that's thin for a tech company.
Very thin. It tells you they're spending heavily to win every dollar of revenue right now. Management is targeting 20% by late 2026, but that's a ways off.
And the spending is showing up everywhere else too.
Yeah.
I saw they missed the Q3 EPS consensus.
Correct. The operational strain is obvious. R&D spending jumped 66% in one quarter. G&A was up 48%. You have to do that to support the growth, but it's risky.
It's that classic high-growth tightrope. You spend too little, you miss the opportunity. You spend too much, too fast, and the whole thing can break.
Precisely. And one last little flag. A Form 144 was filed in November.
For listeners, that's an insider signaling they intend to sell shares.
Correct. It's not a sale yet, just an intent. But, anytime an insider is looking to sell, it's something you have to watch, especially for a story stock like this.
Okay, that's a really balanced view. So looking ahead, what are the big catalysts? The next 3 to 6 months, what should people be watching for?
The single biggest event is the Q4 2025 earnings report. That should be mid-January 2026.
The moment of truth.
It is. They have to deliver on that $20 to $22 million guidance. A miss there would be.
Yeah.
Very bad. It would question the entire inflection point story.
And beyond the official numbers, there's that big government contract rumor that's been making the rounds.
Yes. The Short Range Reconnaissance Tranche 2 program, the SRRP-2. The market chatter is that RCAT is a frontrunner. A decision on that is expected in Q1 2026.
What would a win there mean for them?
It would be huge. It would validate the technology, it would materially boost future revenue, and it would instantly justify that big equity raise. It would signal to the whole defense market that they've arrived as a serious platform provider.
So Q4 earnings and the SRRT2 decision are the big ones. Any other factors?
Yeah, you have potential for volatility from institutional flows. Late January, February, you get the big index rebalancing for ETFs.
Where they could get added, forcing funds to buy shares.
Exactly.
Yeah.
And then you have the 13F filings where the big asset managers have to disclose their positions. If we see a bunch of them bought into that September offering, that will drive a lot more interest.
And technically, the chart seems to be agreeing with the bulls for now.
It's showing bullish signs, yeah. The stock is holding above its 50-day moving average, and it seems to be building a nice base of support above 1050. That's what you want to see. It suggests quiet accumulation.
Which is reflected in the analyst ratings too. Pretty much all buys.
Consensus is a firm buy or strong buy. Some price targets are up around $17. But all of that is conditional on them delivering that Q4 ramp. The market is giving them the benefit of the doubt, but only for now.
So to wrap this all up, what we're looking at is a company at a major turning point. It's moving from being a niche software player to, potentially, a major autonomous platform manufacturer for the defense industry.
That's it in a nutshell. RCAT is at a pivotal inflection point. I would say the risk-reward profile here is asymmetrically bullish for an investor with a 12 to 24-month horizon.
And when you say asymmetrically bullish, you mean the potential upside if they succeed is just dramatically bigger than the downside if they stumble.
That's the definition. The reward from winning in the USV market and landing a contract like SRRT2 is huge. But, and this is the big but, it all comes down to execution on the new division and hitting those Q4 numbers. If they do both, it unlocks a whole new level for the company.
A high-reward, high-risk situation that needs very close attention.
You've got it.
That is a tremendous breakdown. We hope this analysis provides clarity for your portfolio decisions. Don't forget to hit that subscribe button to catch our next look into the markets.